Hello everyone, my name is Nick, and in today's video, I'm going to be sharing with you the top 3 tech stocks to buy now, right after they've just reported their Q2 2021 earnings. I'll also be discussing why I'm so bullish on these companies over the long term, so make sure to stick around for the entire video. And all I simply ask from you in return is just to simply destroy that like button to help support my channel, because it does let me know that you guys like content like this. And if you haven't already, make sure to subscribe down below for more investing content just like this coming out in the near future. But anyways, let's get right into these 3 tech stocks to add to your watch list or to potentially buy. All right, so the first tech stock pick that I have for you today is Facebook with ticker symbol FB. As many of you probably know, I have owned Facebook for several years now. I bought back in 2018 or something like that, but I did recently come out with a video a few months ago stating how I thought that Facebook was incredibly undervalued. At that time, I tripled down on my position at an average price of about $260 per share, and obviously that has proven to be very profitable up until this point, with the stock being up over 35% since. But even to this day, I do still think that Facebook remains slightly undervalued and is a good buy after their Q2 2021 earnings, simply because of how amazing this earnings report was. So on July 28th, Facebook reported EPS of $3.61 versus $3.03 expected by analysts, and then revenue of $29.1 billion versus $27.9 billion expected by analysts. So Facebook did beat on EPS by about 20% above analyst estimates, and then for revenue about 10%, which is nothing less than amazing. Additionally, the company reported their average revenue per user, or the ARPU, which is probably the most important metric for an advertising company like Facebook, and this also beat expectations, coming in at $10.12 versus $9.66 expected by analysts. Then in terms of the user metrics, Facebook was in line with analyst estimates, so the platform is still growing at about 7% year over year, while their family of platforms, including Instagram, Messenger, and WhatsApp, is still growing at 12% per year. Interestingly though, the stock was actually down 4% after hours, and you might be super confused about that, but it is because of their forward-looking statements where they said that revenue growth is going to slow down significantly, but this is primarily due to the company's strength in late 2020, and the comps are very difficult to bounce off of, as well as the fact that the iOS 14 update by Apple, which is affecting Facebook, will have a more profound effect in the second half of the year in Q3 and Q4. But we can see that Facebook maintained their total expenses and CapEx guidance from last quarter, so really nothing has changed in the story, except for maybe the fact that Facebook is handling this iOS 14 update better than expected, and the company is probably slightly benefiting from it. So if we go ahead and calculate Facebook's PE ratio after accounting for their recent Q2 earnings and assuming a share price of about $360 per share, it comes to only 27 right now. Now, in my opinion, that is incredibly cheap for a company that recently grew its EPS 100% year over year. Yes, you heard me correctly, 100% EPS growth year over year, and then their revenue growth was 56% year over year. Facebook always seems to continue beating analyst estimates despite what everyone thinks about the Facebook platform dying, but this just shows the true resiliency of the business model and the fact that advertising online is the way to go, and especially on Facebook. I believe that ad rates will continue to climb on the Facebook platform and elsewhere as businesses continue to reopen, and then the economy gets going again as travel and other leisure activities resume. So anyways, I think Facebook's story is still in the early innings, as they are engineering VR and AR into their games and headsets. That is going to be coming very quickly in the future, so I'm super excited for that, and I'm bullish on this company long term. Now, the second tech stock pick that I have here today is one that I haven't talked about, and that would be Google with ticker symbol GOOG. Interestingly, I haven't owned Google in the past, despite how amazing the company is and how much I believe in YouTube, but I did actually recently buy myself one share at a price of $23.50 after they absolutely destroyed their Q1 2021 earnings. But now that they've reported Q2 earnings, I'm even more bullish on the company than ever, and I think that the reopening of the economy is going to benefit Google substantially over the years to come. So getting into their earnings report, on July 27th, Google reported EPS of $27.26 versus $19.34 expected by analysts, and then revenue of $61.9 billion versus $56.2 billion expected by analysts. So this was a huge beat, guys. Keep in mind, the same quarter last year, Google had EPS of $10.13 and has now exploded to $27.26, which is nearly triple in a single year. So imagine this, Google beat on both the top and bottom lines with flying colors, yet the stock did not even move after hours or the next day. I guess that's just the type of market that we're in right now, where basically all of the good news is baked into the stock price leading into earnings. But regardless, I'm sure that Google is going to rise over the next few months anyways, as it did after the Q1 2021 earnings. Now, what I actually think is most incredible about this earnings report is the amount of YouTube ad revenue that they reported. So YouTube ad revenue grew 84% from Q2 of 2020 to over $7 billion. Despite what anyone might think about YouTube being antiquated like Facebook and that TikTok is taking over the market share and people aren't being on YouTube anymore, it's all nonsense, guys. YouTube is still a growth beast. And I can see YouTube making up a much larger portion of Google's overall ad revenue as the platform continues to grow and people continue to spend more time on it. So if we go ahead and calculate Google's PE ratio after accounting for their recent Q2 earnings and assuming a share price of $2,700, it comes to only 29, while the company usually trades around a PE of 35. Now, in my opinion, I actually think this is very cheap, just like Facebook's case, but for Google, they basically tripled their EPS year over year, and then they still had ad revenue growth of 62%, which was absolutely incredible. I've become super bullish on Google because I simply see them having a monopoly on the internet search market. Like, really, are there any other competitors to Google? And then also them owning YouTube and just me being a huge supporter of YouTube, and I think it has so much potential long term. Now, just like for Facebook, we might see ad rates to continue to climb over the near term, but over the long term and medium term, they will stabilize, of course, but I still see Google and Facebook growing like crazy. Overall, I'll be looking for any dips in the stock to purchase another share or two. All right, now the third and final tech stock pick that I have today has got to be Amazon stock with ticker symbol AMZN. As many of you know, Amazon has been a very high conviction stock pick of mine throughout this year, and its valuation has come down significantly while it's performing still very well. And this Q2 earnings report was absolutely no exception, despite what some investors might think. So on July 29th, Amazon reported EPS of $15.12 versus $12.30 expected by analysts, and then revenue of $113.1 billion versus $115.2 billion expected by analysts. So Amazon beat on EPS quite easily, but they did come in shy on revenue by about $2 billion. And just like Facebook, the management of Amazon did announce on the earnings call that their revenue growth rate throughout the rest of the year will slow down significantly because of the difficult comps in 2020. So as a result of the miss on revenue as well as the forward guidance, the stock was down about 7% the next day, which was a pretty rough day for Amazon shareholders, including myself. But I'm here to tell you that this is only another buying opportunity to be able to get into Amazon stock below $3,500 because I'm sure it won't last long. So if we go ahead and calculate Amazon's PE ratio after accounting for their recent Q2 earnings and assuming a share price of $3,350 where it sits today, it comes to only 58, which is the lowest in the company's history. Now, in my opinion, this price to earnings ratio is incredibly reasonable for a growth beast like Amazon, and here's why. As I've shown in several videos before, Amazon's EPS growth rate over the next 5 years is expected to be 38% per year, which is absolutely incredible. And to be honest, I do think that they're going to beat that, as they have beat so many times in the past few quarters on EPS. And at this rate, the company will easily grow into its valuation and be trading very similarly priced to other tech companies like Microsoft, Google, Apple, and Facebook, while still having a very high rate of growth for their revenue and their earnings. Be sure to check out my other videos that I made on Amazon stock where I do a discounted cash flow analysis actually predicting where the stock price could be in the future, so check out that video that I linked above. Overall, I'm not concerned about this earnings report. We could all expect that the comps were going to be difficult going into 2021, and I think investors just got a little bit too antsy buying into the stock, so this pullback is nothing but a buying opportunity in my opinion. The company is still growing rapidly in both EPS and revenue, so really nothing has changed in the story. It was just a small miss on revenue. And what you need to know is that Amazon usually leads into earnings with very high expectations, and any shred of negative news is going to send the stock tumbling down. I've seen it before several times as I've watched the company perform, and look where they're at today. They're basically at an all-time high, so I don't see this as a problem, I just see it as a buying opportunity, so let me know what you think down below. Anyways, the 3 tech stock picks to buy after Q2 2021 earnings are Facebook, Google, and Amazon, which are arguably some of the best companies in the world. I feel incredibly safe owning these companies because they do have very strong moats, they do have very strong growth rates, and I don't see competitors coming into their industries and disrupting them like crazy. And I do believe that their EPS growth rates will continue to grow at very rapid rates over the near term term and the long term, so that's exactly what I'm looking for as an investor. So guys, don't forget to like this video if you did gather any value from it, and if you haven't already, make sure to subscribe down below as it does really help out my channel, and I will see you guys in the next one.